Imagine you are a central banker right now. You're sitting at your desk, staring at global shipping monitors, and a massive critical sea lane, one that basically powers a huge chunk of the global economy, has essentially just gone blank.
Yeah, just completely dark.
Right. Commercial ships are just vanishing from the map. And because those ships aren't moving, suddenly your entire monetary policy is paralyzed, like your models are just breaking in real time.
It's a terrifying scenario from an analytical perspective
Yeah.
because it really shows how incredibly fragile our systems are. I mean, a physical traffic jam on the exact opposite side of the planet is dictating the cost of capital in your own neighborhood.
Welcome to the week that was. Today, our mission is to trace that exact domino effect. We're going to examine how a physical geopolitical choke point in the Middle East is basically rewiring global macroeconomics, fracturing the Federal Reserve, and ultimately driving this massive institutional flight into digital assets.
And the data on this is just wild.
It really is. We have gathered a stack of sources for you today. We've got geopolitical security reports, global energy data, macroeconomic policy meeting notes, and some highly detailed on-chain forensics. And to help make sense of how physical supply chains are, colliding with digital ledgers, I am joined by our resident expert. Okay, let's unpack this. Let's start with the Strait of Hormuz.
Right, so that is the epicenter of everything we are seeing in the macro data right now. To really understand the economic fallout, we have to look at the shipping logs first. Standard commercial traffic through the strait has plummeted from about 3,000 vessels a month down to just 154.
Wait, really? 3,000 down to 154? That is basically zero.
Yeah, the waterway is effectively paralyzed.
But the reports mention that even those remaining ships, those 154, are mostly a shadow fleet. What exactly does that mean in practical terms, like for the actual supply chain?
Well, a shadow fleet refers to vessels that deliberately obscure their identities and locations. So they turn off their automatic tracking transponders. They use, these really complex corporate structures to hide who actually owns the ship.
Oh, wow.
And they frequently transfer cargo ship to ship right in the middle of the ocean to avoid detection. I mean, they are actively evading the blockade. But the reality is you can't run a global economy on a shadow fleet.
No, of course not. And the diplomatic efforts to resolve this seem completely gridlocked. Based on the security reports we looked at, Iran submitted a two-stage plan, which was brokered by Pakistan, to reopen the strait. But the United States rejected it outright.
Yeah, they did. And the analytical breakdown there is that the U.S. felt the plan lacked verifiable atomic concessions. So from their perspective, lifting a naval blockade without securing a firm agreement on Iran's nuclear program would basically mean surrendering their primary diplomatic leverage.
Right, so there is no diplomatic off-ramp right now. Instead, we see the U.S. State Department forming the maritime freedom construct to physically enforce sanctions and break the blockade. Meanwhile, Iran is activating air defense systems in Tehran. So this tension isn't just theoretical anymore, it is highly kinetic.
Exactly.
And I am looking at the immediate energy fallout here. Brent crude oil surged past $110, approaching $120 a barrel. I mean, think of the Strait of Hormuz as the global economy's carotid artery. You pinch it, and the entire system starves for oxygen.
That is a perfect way to put it, and that is where a localized military standoff becomes a full-blown global economic crisis. The Dallas Fed is currently modeling a 2.9% annualized GDP contraction for every single quarter that the strait remains closed.
See, that feels kind of abstract. A 2.9% GDP contraction sounds like a rounding error, but it is massive. Why is the impact so severe? It is not just about, paying more for gasoline at the pump, is it?
Oh no, far from it. When we look at the actual cargo data, this closure traps about 1/3 of the global seaborne methanol supply. And on top of that, massive, massive amounts of international fertilizers.
Okay, wait, let's pause right there. If you trap fertilizer, you are directly hitting global agriculture.
Precisely. If we connect this to the bigger picture, without fertilizer, your crop yields drop. When crop yields drop, the cost of food skyrockets globally. So you aren't just looking at an energy shock anymore. You are looking at a structural supply shock cascading across agriculture, manufacturing, and transportation all at exactly the same time.
Which guarantees sticky, elevated inflation worldwide.
Exactly.
And that structural shock explains a frankly stunning piece of news in our stack. After 59 years, the United Arab Emirates just announced they are leaving OPEC.
Yeah, that was huge.
I read that and had to do a double take.
When a nation like the UAE simply walks away from OPEC after almost 6 decades, What does that signal about the severity of this energy panic? It signals a complete structural breakdown. It really comes down to drastically divergent domestic break-even points. So, the UAE recently executed a massive investment program to push their state energy producers' capacity up to like 5 million barrels a day.
Okay.
And to balance their national budget, they only need oil to be at $50 a barrel. They want to pump and sell as much as possible right now.
But Saudi Arabia is in a completely different position.
Yes. Saudi Arabia is funding these massive domestic infrastructure initiatives, and they need oil to stay around $90 a barrel just to balance their books.
Wow, so almost double.
Yeah. So the cartel is fracturing because the blockade is creating unbearable financial pressure. They can no longer agree on production quotas. You even have Japan executing emergency protocols to release 20 days of their national oil reserves just to keep their lights on. The whole era of cheap, reliable energy driving easy economic growth is completely suspended right now.
So if energy is the floor of the global economy, the floor just shot up. And that instantly hits the ceiling, which is the Federal Reserve. Because this energy crisis in the Middle East has fundamentally paralyzed Washington, D.C.
Completely paralyzed them. The Federal Reserve relies on inflation metrics to set their interest rates. But with the cost of oil, methanol, and fertilizer driving all those inflation metrics higher, the Fed simply cannot lower rates, no matter how much the broader economy might actually need it.
The latest notes from the Federal Open Market Committee meeting are just fascinating. They held the federal funds rate at a highly restrictive 3.50% to 3.75%. But, the rate itself isn't really the story.
Right. It's the vote.
Exactly. The story is the vote. It was an 8-4 divided vote. I dug into the history on this, and that is the highest level of dissent within the Fed since 1992. But, why does a divided vote matter to you, listening at home? If the rate stays the same anyway, who cares if they disagreed on it?
Because central banks basically trade on credibility and forward guidance. Usually, the Fed projects this absolute unified consensus to calm the markets. They want you to believe they have total control of the economic trajectory.
Right.
So an 8-4 split is essentially the governors loudly admitting that they fundamentally disagree on where the U.S. economy is heading, and they disagree on how to fix it. It strips away that entire illusion of control.
And the internal politics are getting really messy. Outgoing Chair Jerome Powell announced he is staying on the Board of Governors after his term expires. That seems incredibly rare, and it creates a highly hostile environment for his incoming successor, Kevin Warsh. And Powell explicitly pointed to the ongoing energy price surge as his reason for staying.
Yeah, the stakes are incredibly high right now. The hawkish stance that is required to fight this persistent energy inflation keeps Treasury yields high, but that creates a highly toxic environment for traditional risk assets.
And the warning signs are flashing bright red. The ratio of total stock market capitalization to gross domestic product has hit 252%. We have billionaire investor Paul Tudor Jones publicly warning that the S&P 500 implies negative 10-year forward returns.
Yeah, negative returns over a decade.
It's staggering. And he explicitly designated Bitcoin as the ultimate inflation hedge, superior to physical gold. But, I want to push back on this traditional financial logic a bit.
Go ahead.
If interest rates are staying high, the old-school traditional playbook says investors should flock to government bonds, right? You lock in a safe, high yield. So why are legendary fiduciaries like Paul Tudor Jones abandoning the standard playbook and pointing directly to Bitcoin instead of gold or treasuries?
Well, it comes down to the mechanics of a high discount rate. Elevated risk-free rates basically act as a regressive tax on capital formation.
Whoa, okay, regressive tax on capital formation. We need to translate that for the listener's retirement account. Are you basically saying that when safe government bonds pay a high yield, investors just refuse to take risks on regular company stocks?
That is a perfect translation. If a 10-year treasury yields a high guaranteed return, why would you take a risk on a volatile technology company?
Right.
The government is basically paying you to take zero risk, and that compresses the valuation of traditional equities. But there is a massive catch here, and it goes right back to our first segment.
The inflation from the energy shock.
Precisely. The fiat currency the government pays you back with is aggressively losing purchasing power. So your quote-unquote safe bond yield is being eaten alive by the rising cost of food and energy. Deep value allocators are looking at this environment and realizing that Bitcoin has zero supply elasticity.
Meaning no central bank can just print more of it to paper over their debts.
Yes. That makes it a true mathematical defense against fiat debasement in a high inflation environment.
And that connects perfectly to the on-chain forensics we reviewed for this deep dive. because we are seeing a massive institutional flight to hard assets. Now, the surface level data looks pretty chaotic. We saw Bitcoin ping-ponging violently between $74,000 and $79,000.
Yeah, that chop wiped out hundreds of millions in leveraged positions, both longs and shorts.
Exactly. Retail day traders got absolutely chopped to pieces.
But if you look beneath that volatility, the corporate and institutional behavior is entirely different. They aren't day trading. They are using those price drops as strategic acquisition zones.
And the accumulation numbers are wild. In the middle of all that price chop, U.S. spot ETFs had their biggest accumulation month of the year. They absorbed $2.44 billion.
Yeah.
Now, there is a clear divide here. Grayscale is bleeding assets rapidly, but BlackRock's iShares Trust, which now holds a $62 billion valuation, by the way, in Fidelity, are seeing massive inflows. Why the huge shift between funds?
Well, it largely comes down to fee structures and utility. Grayscale's fees are relatively high, so investors are rotating out. But more importantly, these ETFs now function as a macro-correlated proxy vehicle for traditional finance.
What do you mean by proxy vehicle?
Well, registered investment advisors can't easily buy raw, self-custodied digital assets for their clients. It's an infrastructure issue. So they move capital out of those traditional equities that are threatened by high interest rates, and they park it in the spot ETFs instead.
But the ETFs are just paper claims. The real story is the physical accumulation. Let's look at Strategy Inc. It's like they're taking a giant straw, drinking the fiat liquidity out of traditional markets, and locking it permanently into the Bitcoin ledger. They just acquired another 13,927 Bitcoin.
Right, bringing their total treasury to roughly 818,000 Bitcoin.
Which is close to 3.9% of the total terminal supply of the entire asset. But I want to talk about how they bought it, because the mechanics feel counterintuitive.
Ah, the convertible debt strategy.
Yes. They funded this massive $1 billion purchase by issuing preferred shares with a fixed 11.5% dividend. They are guaranteeing an 11.5% payout just to borrow this money. I mean, if I went to my financial advisor and said, hey, I'm going to take out a mortgage at 11.5% to buy a highly volatile digital asset, they would fire me on the spot. How does that math actually work for a publicly traded corporate treasury?
It sounds totally reckless until you break down the corporate game theory. Strategy Inc.'s management is looking at the macro environment. You know, the inflation, the blocked supply chains, the paralyzed central banks, and they're making a highly calculated bet against the fiat currency system itself.
So they are assuming the currency they are borrowing will devalue faster than the interest they actually owe.
Exactly. Think of it like taking out a fixed-rate mortgage right before a period of hyperinflation hits. Your monthly payment stays exactly the same, but the currency you use to pay it becomes easier and easier to acquire. Yeah, they calculate that the long-term appreciation of an absolutely scarce asset will easily outperform an 11.5% fiat cost of capital. I mean, they are using the legacy system's own credit mechanisms to extract capital and preserve it in a ledger that the legacy system cannot dilute.
That is just brilliant. And they aren't the only ones executing aggressive physical strategies to survive this macro environment. We have to talk about what Emory Holdings just did because it brings this entire conversation full circle.
Right, the Ohio acquisition.
Yes. Emory just executed a $1.52 billion acquisition of a 505-megawatt gas turbine power plant in Ohio, complete with 1,600 acres of industrial land. They are building a massive campus for AI and high-performance computing. I have to laugh a bit because it feels like the ultimate extreme of trying to avoid paying a standard utility bill.
Yeah.
But analytically, it's pretty smart.
It is vertical integration born entirely out of necessity. Think about it. Why do we start this whole analysis talking about the Strait of Hormuz?
The energy shocks.
Right. Energy shocks cripple businesses. High crude prices elevate electricity costs on the global grid. And for digital miners or AI data centers, electricity is their primary operating cost. When the grid gets expensive, inefficient operations go bankrupt.
So by owning the power plant.
Exactly. By purchasing their own natural gas power plant, they completely insulate their operations from the exact global energy shocks we discussed in segment 1.
They are essentially unplugging themselves from the chaos of the global energy supply chain. So if a publicly traded corporation will go to the lengths of buying a literal power plant to insulate themselves, what happens when entire sovereign nations realize their wealth is vulnerable?
And this is exactly where the geopolitical and the cryptographic worlds collide.
All right. Our policy sources reveal that a lawmaker in Taiwan has formally proposed establishing a strategic Bitcoin reserve. Let's look at the context here. Taiwan currently holds $602 billion in sovereign reserves, but 80% of that capital is held in U.S. dollar-denominated assets.
Yeah, that's a huge vulnerability for them.
The proposal argues that a Chinese maritime blockade could trap those fiat reserves, making an unconfiscatable multi-signature cryptographic treasury an absolute national security necessity. I mean, Taiwan is watching the Strait of Hormuz right now and realizing that could be us in the South China Sea.
Absolutely.
But I'm trying to visualize the actual mechanics of this. If a ring of naval warships is physically blockading your ports, how exactly does holding a digital asset solve the physical problem of moving your national wealth?
Well, what's fascinating here is that it solves the problem of physical settlement.
Mm-hmm.
If your national wealth is in physical gold, you literally cannot move it through a naval blockade. It is trapped. If your wealth is in U.S. treasuries, you don't actually hold the physical asset.
Right, it's just a number on a screen.
Exactly. You hold a database entry that relies on the SWIFT messaging system, and SWIFT requires permission from third parties. If a conflict breaks out, those lines can be sanctioned, disconnected, or completely frozen by the issuers.
So fiat relies on permission and physical infrastructure that can be seized.
Yes. But a digital treasury secured by cryptographic multi-signature architecture, meaning multiple secure keys, are required to authorize a transaction that does not require physical transport, and it does not rely on SWIFT.
Right.
As long as the nation has internet connectivity, even just through satellite networks, the global blockchain continues to validate blocks regardless of kinetic warfare on the ground. A hostile state actor cannot physically seize the funds, and they cannot freeze the network.
So your national wealth remains liquid and accessible on a global market no matter what. But the security data points out a deeply uncomfortable truth here. That same unconfiscatable nature is a double-edged sword, because it works for the actors creating the blockades too.
Yeah, it's entirely neutral.
The U.S. Treasury issued a specific warning to the global maritime industry that Iran is demanding maritime tolls in cryptocurrency for safe passage through the Strait of Hormuz. Because the ledger is neutral, it bypasses U.S. sanctions just as easily as it bypasses a Chinese blockade.
The protocol just does not care about geopolitics. And that is why the U.S. military increasingly views blockchain infrastructure as a domain of financial warfare, simply because it continues to operate when physical infrastructure fails.
Which perfectly explains the absolute regulatory sprint happening in the United States right now. The government is moving incredibly fast. The SEC just introduced the ACT strategy, categorizing Bitcoin, Ethereum, and several other assets as digital commodities.
Which is huge because it moves them out of the regulatory purgatory of being unregistered securities.
And concurrently, lawmakers reached a compromise on the Clarity Act. This regulates stablecoin yields, essentially preventing digital dollars from acting like traditional, unregulated bank accounts while still allowing the actual technology to flourish.
But arguably the biggest piece of legislation is the American Reserves Modernization Act.
Yes, aiming to systematically acquire 1 million Bitcoin for the U.S. Treasury.
Yeah, and the U.S. already holds over 328,000 Bitcoin, largely from law enforcement seizures. Now they are moving to actually codify that into a strategic reserve. It is a very stark contrast to what we see happening in Canada.
Oh man, Canada is taking the exact opposite approach. According to their economic update, Canada just announced an outright federal ban on all 4,000 of its cryptocurrency ATMs.
All of them.
All of them. They are citing massive consumer fraud, like $704 million worth. And they are deploying hundreds of millions of dollars to build a new financial crimes agency, essentially forcing retail investors back into legacy financial institutions.
It highlights a deep, fundamental divide in how different nations perceive this whole shift. The U.S. and Taiwan are looking at the macro data and viewing digital assets as a geopolitical necessity. Canada is looking at the micro data and treating it strictly as a retail consumer protection hazard.
And, I mean, to be fair to Canada, the security risks in the ecosystem are massive. Our blockchain intelligence reports show that North Korea executed 76% of all crypto thefts over the past year.
That is a staggering metric.
They extracted over $1.46 billion from the Bybit exchange and nearly $300 million from the Drift protocol.
And we should really clarify, these aren't just brute force coding hacks.
Right. They are using advanced AI tools and deep social engineering. The Drift protocol attack reportedly required months of elaborate in-person meetings between North Korean proxies and the protocol developers before the exploit was ever executed. It raises a huge question. If state actors are deploying this level of resources, can the underlying network actually withstand the assault?
Well, that is the constant arms race of open source development, but the network is aggressively pushing back.
Yes, the engineering response has been fascinating to read about. Developers just integrated BIP 360 into the core repository. For the non-engineers listening, BIP stands for Bitcoin Improvement Proposal. BIP 360 establishes a wallet architecture designed to be resilient against quantum computing threats.
Yeah, post-quantum decryption defense.
And it's already deployed on a testing network. The system is actively hardening itself against state-level attacks.
It really proves the resilience of decentralized infrastructure. It just evolves under pressure.
Which leads to a fascinating full-circle moment in our source material today. Jack Dorsey recently announced he's using the Bitcoin network and the Nostra protocol, which is a decentralized social media and data relay system to distribute a WikiLeaks documentary.
Bypassing traditional streaming platforms entirely.
Completely. And he explicitly pointed back to the 2011 financial blockade of WikiLeaks by legacy credit card companies as the historical proof of concept for why decentralized networks had to exist in the first place.
It perfectly distills the core utility of everything we've discussed today. Whether you are a documentary filmmaker facing a corporate payment blockade or a sovereign nation facing a naval fleet in the South China Sea, the fundamental value proposition is exactly the same. It's censorship resistance.
Let's pull all of this together. We started by looking at an empty map of the Strait of Hormuz. We unpacked how that physical supply chain breakdown paralyzed the flow of oil and fertilizer, leading to a massive structural energy shock.
Right.
We traced how that inflation fractured the Federal Reserve, leaving them gridlocked with high interest rates that crush traditional investments. And finally, we saw how that macroeconomic squeeze is sparking a desperate, highly calculated land grab for digital commodities by corporations and sovereign wealth funds trying to insulate themselves.
The global financial architecture is undergoing an extreme stress test. And the primary takeaway from all the data is that the smartest institutional money isn't panicking. They are looking at the friction in the physical world, and they are actively using the chaos to harden their balance sheets with digital scarcity.
They are abandoning assets that can be inflated or physically blockaded, and moving toward assets that rely entirely on math. Which leaves us with a final question for you, the listener, to ponder on your own as you look at your own portfolio. If sovereign nations and massive publicly traded corporations are fundamentally restructuring their treasuries to survive global blockades and fiat debasement, what is the Strait of Hormuz in your own personal financial plan, and how are you preparing for it? Thank you so much for joining us for this week's deep dive into the source material. We'll be back next time to unpack the next layer of the global puzzle. Take care.